All right, we'll let that gunculate. Cool. All right, guys. So welcome. Thank you for coming. This is the 2022 market forecast with a look back on 2021. So there is going to be a recording of this. So if you got to bounce out, don't feel bad. You probably get it within usually 2 or 3 days of me cutting it. So without further ado, let's get into it. So first, some quick housekeeping and disclaimers. So if you have any questions, you can put them in the Q&A box and we'll answer them at the end. Chat box works as well. This isn't, legal advice. Do your own due diligence. This isn't an offering or anything like that. And like I said, you'll get the replay within 24 to 48 hours. So all right, the boring stuff over. All right, so this is what we're going to be looking at today. So first, we're going to start off. We'll do a 2021 look back, kind of see where we're coming from to understand where we're going and where we are right now as well. So that's going to entail an economic rundown. So we'll talk about the performance of the economy in 2021 and what we're seeing in the forecast for 2022. We'll talk about the elephant in the room, rising inflation. That's all anyone could talk about. Interest rate expectations in line with that as well, and just an overview of the multifamily markets. So, and then of course the Q&A as well. There we go. All right, so quick intro in case you're joining and you are not familiar with me and kind of what I do and what my background is. So I grew up in the Boston area, born and raised there, went to college on Air Force ROTC scholarship. So when I graduated college, I had a job waiting for me in the Air Force. I went to Pensacola, Florida, did my flight training, ended up flying jets for the Air Force. I was active duty for 8 years, got about 2,500 hours in the B-1 bomber. So that's my background. And ever since, I've been really focused on investment property. So I got my first investment property back in 2011. So I moved up to my duty station up in South Dakota, and I bought a duplex. So I was kind of tired of renting for a few years. It seemed like at the time, real estate was a pretty hot topic because of everything going on in 2008, 2009, 2010. So I wanted to be a part of it. So I got this duplex. I didn't know the first thing about real estate. I didn't know what I was doing. I just kind of did some back of the napkin common sense math, and it all worked out really well. So I got another one a couple of years later and another one a couple of years later. So by the time I left the Air Force, I had a little cash flowing portfolio of rental properties. And pretty soon I realized that was the most beneficial thing that I took with me from my time at that job, was leaving with this awesome investment to continue putting cash in my pockets. I was also very fortunate. I got into crypto way back in 2013 when everyone thought it was a joke. And that's done really well for me. So I've been able to put some of that money to work in real estate and hope to have another bullish crypto season and put some more money to work in real estate would be ideal. So with my focus on real estate, I founded Mach 1 Equity back in late 2019, probably really didn't get going until 2020. And I've got a few projects to highlight. So on the left is the Glen Oaks Apartments. That's a 232 unit apartment complex that we took down back in March. And that was a deep value add. So we took over, I think we're at like 70% occupancy. We've since got it up to around 93%. And we kind of been hanging out in that area while we forced evictions and forced turnovers in order to affect our business plan of renovating the units and turning that property around. So really excited for where that is and where that's going in the next year or two. Top right is the Ganala Plaza. It's a medical office development that we undertook in Loveland, Colorado, and really pleased that we just sold that. So we got that under contract to sell for $1.925 million. I think our original pro forma price was about $1.8 million. So pretty happy with that. That was definitely a challenging project due to, developing during COVID and all the challenges that came from the shutdowns and the labor shortages and the materials and labor prices skyrocketing definitely presented some challenges. But overall, I think it's a good exit price for us. And then my most recent acquisition that I'm really excited about, I know my friend Todd there on the right side is my partner, and he's on this call as well. So little shout out to Todd. I think we're going to do a case study on this in next month. So look forward to that. We'll do a webinar. So the Southcourt Mobile Home Park, it's 55 units in Batesville, Arkansas. So definitely a different product type for me. Todd is the expert on trailer parks. So me and him partnered on a JV, and we're looking forward to turning that park around over the next year. So some exciting stuff going on at the park as we speak, I think. Thanks, Todd. All right, so let's go forward. Let's go back to 2020. This is pre-pandemic. What was going on with the economy? This is just a snapshot. Basically, everything was peachy. We're adding a couple 100,000 jobs every month. The unemployment rate was at like an all-time low, 3.5%. GDP was trucking along at a slow and steady 2%. And the Fed rate was at a cushy 1.5%. So overall, I wanted to put this in here. I just took this right from last year's market forecast because it gives a good kind of baseline of like, what is it that the recovery is aiming to get back to, right? This is our sort of baseline economic kind of 5-pack, if you will. So that's what we were doing at the start of 2020. At the start of 2021, what we were expecting to happen over the last year. So this is what the forecast basically was for 2021. So taking a look at these numbers: GDP 3.5%, inflation 2.25%, unemployment 6%, and interest rates flat. We basically overshot all these except for interest rates remained flat, but we basically beat all of these. I don't know if you consider high inflation we didn't beat it, but we came above that for sure. So overall, the consensuses were pretty wrong, but a lot of that is to our benefit. So let's talk about it. Let's start off with the labor market. So how did we do in 2021? We added 6.4 million jobs. That still leaves us a few million below our highs in February of 2020. But overall, it's a really successful year for the recovery. We added over 500,000 jobs per month, and we were looking to add about 400,000 to 600,000 a month on average. That's kind of what we needed to have a strong recovery, and we met that. So that is good news. The unemployment rate was brought down all the way to 3.9%. So we're pretty much at pandemic levels with that, depending on how you look at it. Now, there's a caveat with that. That's why I have there the true unemployment, 6 to 7%, because labor force participation is down 1.5%. So what that means is there's millions of Americans that either quit their jobs, retired from their jobs, or lost their jobs that never returned to the workforce for a variety of reasons. But it's kind of being dubbed the Great Resignation right now. So a large part of that is people retiring, people 55 and older. They're in a position to retire. Maybe they're holding on to their jobs because why not? They're still, 50, 60, still got a lot of life in them. They don't really know what they're going to do if they just fully retire. What are they going to do? How are they going to spend their days? Maybe they got a spouse that works or whatever the case may be. Or maybe they're just trying to maximize the final years of their working years as they save for retirement, since that's probably when they're at their highest earning potential, right? They have a lifetime of wage increases behind them. So, but as the shutdown occurred and the pandemic hit, a lot of those people just said, the hell with it. I'm done with this. I'm going to retire. A lot of them moved to some of these Sun Belt markets that we're going to talk about with the migration we're seeing there. And yeah, and I think we're going to talk a little bit about the effect on households as well, but there's also been some women that have left the workforce to raise a family. is what it comes down to. So a lot of households moving to a single income household as they rear children. Wage growth came in at 4.7%. So that's a very strong year for wage growth. We haven't seen that in quite some time, that level of wage growth. I think it's a good thing because a lot of it came to the hourly workers, the sort of lower class of wage earners, and they really need it. I mean, there is wealth disparity in this country. Costs are rising, inflation is picking up. As you'll see, rent went up significantly this year. So I think the wage growth is important for those people to be able to afford to pay those higher costs, right? So I expect we're going to continue to see strong wage growth into 2022. Right now, I think it's about around 10 million job openings. But what's interesting is they're still having trouble filling those job openings because, as you see, the labor force is largely employed, but there's a lot of pressure to raise wages. We're seeing increased strike activity across the country, and just in general, there's a lot of pressure to raise wages. So I think that is something that's going to happen slowly, but surely over the next year. All right, so what is the impacts from consumers? So consumer spending, there's an excess of dry powder from consumers. So they have like $5 trillion worth of additional funds in savings and money market accounts compared to pre-pandemic levels. And they've been putting it to work. So retail spending is up 16.5% year over year. Now, what's interesting about that, or I don't want to say it's a downside of that, but it kind of is that it's adding strain to the supply chain. So it's continuing to strain the supply chain, which has been struggling since COVID, especially because we had those shutdowns, and the supply chain has had a real tough time of catching back up to our typical expectations, right? Shipping costs are through the roof. There's delays coming from foreign countries. Every country has different restrictions on COVID, and they're seeing shortages of actual storage containers to ship stuff in, shortages of room to put storage containers. I mean, I heard reports of shipping ships full of these shipping containers that are sitting outside the port for weeks, months, because there's no room at the port to put the containers. So some interesting things. That's going to be something we're going to continue to see over the next year. It's kind of a variable that we'll have to contend with, is these supply chain issues. But overall, consumers have excess money and they are putting it to work. And that's really helping our GDP. So as I said, GDP in 2020, so this is going back 2 years. During the pandemic, height of the pandemic, we lost 3.5% GDP, and that was being propped up by strong retail. That's also propped up by the stimulus and aid we saw that year, right? So, so that's where we were coming from, negative 3.5%. Where'd we end up for 2021 was 6% GDP growth, which is very strong, highest rate in 40 years. We're going to continue to see strong GDP. We're forecasting 4 to 5% for 2022. But like I said, the economy right now is trying to seek a balance between, rising inflation, the supply chain challenges, this challenging labor market where employers are trying to find what the balance is between wages and, what they can expect from their employees. Also, the shift to work from home. So that adds a whole nother dynamic that, there were some places that offered work from home, but now it's become something. I mean, I know a friend of mine just got a new job, and that was a big part of her job search. The discussion was she was working from home at her previous job. So the new job that wanted her to actually come in person, she said, well, I'll do that, but I want more money. So now it's a bargaining chip of employees potentially requesting more money because now they're commuting to work. So that's their time. They're paying for gas. So we're still kind of finding this equilibrium between work from home, working in an office, and a lot of that stuff is going to take probably a few years to really balance out. So it'll be interesting to see how that plays out. Now, inflation. So inflation is probably the most talked about thing recently. So this is coming off of, in 2020 and 2021 we had massive influx of stimulus and infrastructure spending from the federal government. The money supply, they increased by like 30%. And what did that lead to? Every action has a reaction. 2021 inflation comes in at about 7%. So this is the highest since the early 80s. And contrary to what the mantra coming out of the Fed and the government, it's not transitory. It's expected to remain, but we will hopefully see a gradual ease over the next, couple of years. But right now, forecast for 2022 expect inflation to still come in high at 4 to 5%. So remember, previously the Fed target is always usually around 2% was what they're targeting. Generally, they're coming in below that, but now they're starting to look at this rising inflation that we're seeing and expect them to be a little bit more aggressive in combating that and changing their monetary policy. So with that, the Fed watch. So we got Jerome Powell, the Fed chair, looking sharp in his new suit. He's tightening monetary policy. So they're rolling back the asset purchase program, which is the Fed was spending like $120 billion a month, these asset purchases, in order to help prop up the economy. But now with inflation high up at 7%, and keep in mind that 7% is probably low, actually. It doesn't incorporate a lot of the price increases that we have actually experienced in the real world, one of them being rent, because rent tends to lag. CPI tends to be a lagging indicator, so it's always a little bit behind. So the rent increases that we've seen, which we'll talk about in upcoming slides, haven't trickled their way into those CPI numbers. So we could actually see those get worse before they start to get better. But so the Fed, in response, is tightening their monetary policy, and they have said they expect to increase the Fed rate by 25 basis points, so a quarter of a percentage point, 2 to 3 times this year. So we do expect the Fed rate to rise. What I've seen from the Fed over the last couple of years is they tend to be pretty nimble and pretty quick to change their policy if need be. I mean, they were very quick to react to the pandemic, probably the most efficient in terms of their response, when the pandemic hit, which is probably just due to their independence from the rest of the government. But it wouldn't surprise me for them to change their tune if some additional information comes in. So maybe they raise it more, maybe they only do 1 or 2 raises instead of 3. We'll see. But that's what they are projecting is 3 raises. So expect that. All right, so that's the economic rundown. So hopefully that was a nice 20 minutes rundown, give us a good macro level 30,000 foot view of the economy and what how the nation is kind of doing. So now let's shift gears. Let's get into multifamily performance and trends. So we'll kick it off. We'll start with the National Multifamily Housing Council Rent Payment Tracker. So this is something that they started publishing soon after the pandemic hit. And this is full month collections. You can see there on the left, it's July to December, but it compares 2019, 2020, and 2021. So you get this nice pre-pandemic, peak pandemic, post-pandemic look. And if you look at the final collections on the right-hand side, you'll see there is probably a 3% average disparity between 2019 and 2021. So collections have taken a hit throughout this. Now it's noticeable. I would say it's not significant, or at least not worrisome, just because all the other trends that we'll discuss have been overwhelmingly positive. So I think this is, if I had to guess, it's probably a factor of, because rent is increasing, landlords at these properties, as their leases expire, they're pushing the rents up. And some of those tenants that, they could afford the previous rent, they can no longer afford the new in place rent, but they're having a hard time moving out, or they're just lingering for whatever reason. Like I said, evictions are taking longer. So that is a factor that could play into this. So I think this is something that'll probably over time sort of work its way out, and we'll see that ultimately collections start to rise through 2022 is my prediction. All right, so what did rents do last year? Ooh, that is impressive. So you can see overall rents for the entire nation up 13.5% in 2021. So just incredible growth. Lifestyle class is up 16%. And this is the national average. You break it down by specific markets, which we'll show you. Some of the markets are in the mid-20s. So this is unprecedented rent growth. There is not a single person that I'm aware of that even in their most bullish scenario would have predicted these types of rent raises. So if you're an apartment owner, this is muy bueno. This is really good if you're an owner already. I mean, it's just incredible growth. It really speaks to the demand for housing that we currently have a shortage of. So same thing with the occupancy rates. We see this dip in the early stages of the pandemic, and this quick rebound back to now we're above even 2015 occupancy rates. So occupancy is very strong, rent is on the rise, and we expect that to remain. So this chart, I like this chart. This chart shows the dark blue line up top is home prices year over year growth, and the light blue line is multifamily rents. So what you can see is that dark blue line kind of starts to, it's a slight raise going into 2020, and then it starts to this ever so slight decline when the pandemic hits, and then that quickly rebounded as summer came and the economy started opening up and the housing market returned and sales started picking up. You just see this monster rise, and now it's up 20% year over year. Granted, this is through September, but still 20% growth compared to multifamily rents. And what I like about this chart is if you look at that where home prices start to raise, and you see this delay in multifamily rents where they just stagnated for whatever that works out to be 6 to 9 months there. And that's what you should expect to see, because rent tends to lag home price growth. So home price growth is a leading indicator of rent. So if you're investing in a market that is seeing outsized appreciation, generally 6 to 12 months later, you'll see rent start to raise in line with that as well. So this is just a really good chart to display that relationship between home prices and rents. As people get priced out of the apartment market, they're forced to stay priced out of the single family home buying market, they're forced to stay in apartments, which helps drive apartment demand. Okay, so this is looking at some markets specifically and what their year over year rent growth. So this has a lot of information. I'm not going to go through every one of these cities or data points, but it's just a really good snapshot to show you year over year rent growth, occupancy, and forecasted rent growth for 2022. So overall, the most rent growth is happening in these tech hubs and a lot of these Sunbelt markets that have seen a lot of migration throughout the pandemic. People are moving to lower cost of living markets, and also more, I guess, rural. They're moving out of those gateway urban environments towards the suburbs, and some of these markets, lend themselves to that. So like I said, I mean, look at Las Vegas at the top of the pack, 22.8% rent growth. That's insane. You can't even wrap your brain around it. And they're expected another 7.8% in 2022. So you can take some time in the replay and, look at the specific markets. This has in bold the gateway markets that tend to underperform the other markets there, but overall still really, really strong rent growth across the board. The amount of double-digit rent growth is unprecedented, and it'll probably never happen again in our lifetime. But we're still forecasting for 2022 rent growth of 4 to 5%. So that alone would be like a banner year. You'd be cheering 4.5%, 5% growth any other year. And now we get this just extreme bump due to, just kind of some of the unique factors that came out of this pandemic. So a lot of it just comes down to supply and demand. So absorption in 2021 was off the charts. It was about 50% increase over previous highs. And you can see that completions in dark blue, they're ticking up. So there's definitely increased development occurring to try and meet this demand, but it's not going to come anywhere close. And absorptions for 2022 are in the top probably 400,000 units. And then you can see the vacancy rate reflects that. So overall, there's just not enough supply. We just can't build fast enough to meet demand. And, if you own apartments already, that's probably good. This chart, it shows single family completions and multifamily completions, and it adds this orange line, which is household formation. So I want to highlight this. This is something that is also helping to drive demand, especially in some of those, I think, suburban markets where households are forming at a much higher rate than they were in 2020. Looks like 100% growth. So, or maybe 200%. So this factors into what I spoke about earlier during the economic portion of consumer savings and wage growth. Those two are combining to help drive household formations. Specifically, when we look at the labor force participation rates amongst men versus women, there was a decline for women post-pandemic that hasn't fully recovered. And the kind of running theory is that because schools were shutting down and childcare services were shutting down, a lot of women were forced to take care of their children. And a lot of households moved to a single income household that had previously been dual income. And then, of course, there's also COVID babies that are popping up. So that's driving household formations to increase significantly. And that's driving increased home prices, and families want to buy a house or rent a house, right? So makes sense. All right, let's talk about sales trends. So that's the kind of perspective of what's driving rents and the kind of fundamentals from an operations perspective. But from a sales perspective, it's a hot market. So we're seeing this annual volume. So that's the blue bar there is topping, close to 170 billion in annual sales volume, which is much higher than it's almost twice what we had the previous year. And then your price per unit is up from about 140 to about 170, call it, a door. So what we're seeing is cap rates continue to compress and pricing continues to increase. And that I would not expect to change as a result of interest rates. I wanted to highlight that because there is often this kind of correlation: as interest rates rise, cap rates will rise because your purchasing power changes based on your interest rate, right? So your you have this inverse relationship somewhat between interest rates and sales price, but it's not the only factor at play. And the big thing right now is there's just so much capital moving into assets, real assets like real estate, that it's kind of like interest rates be damned, cap rates be damned. You kind of got to throw it out the window for a lot of these markets. I mean, there's properties trading, a lot of sub 4 caps and even some sub 3 caps, depending on where it is. And I think my personal intuition on one of the things that's happening that's driving this highly competitive landscape for purchasers is that your institutional investors, traditionally they were buying what was called institutional grade assets, right? Which just means it was a big enough deal to be of interest to them. They didn't want to do a $10 million deal. They want to do a $100 million deal. They want to buy 1,000 units, 300 units. They don't want to buy a 100-unit apartment complex. But as the market has tightened up and they're chasing yield, they're having to adjust the deal size that they're willing to pursue in order to see that yield realized. And they're also generally investing on a much longer timeline and have different kind of risk metrics, expectations than a lot of your private investors or syndications, et cetera. So now they're starting to trickle down to compete with those private investors that were typically hanging out in that, maybe sub 300 unit purchases. Now we're seeing institutions will buy 100 units or less in some cases. They're also moving from, gateway and secondary markets. They're starting to move into tertiary and growth markets, again, in an effort to chase yield. And I think it's tough to compete with some of the institutions because for them, they're happy to see, 2-3% return for a few years because they're looking 10, 15 years out, and then they know they'll make it up on the back end. Whereas a lot of your kind of retail investors, typically a lot of your syndicators are trying to get them 7 or 8% preferred return. I think that's going to be more and more challenging in this landscape. And they're making some concessions in order to provide that on their end. But it's, I don't know, we could be entering into a new kind of era where you have to dial down some of your expectations because these prices are just so high, and in a lot of ways they're just overpriced, frankly. I don't see a lot of reason to invest in a 3-cap property, but it depends. I guess the whole way people underwrite, I think, has shifted since even 3 years ago. All right, and we got to give a shout out to the single family sector. So the single family rental model has gained significant prominence in the last few years, and they also have achieved massive double-digit unprecedented rent growth, up in over 14%, and solid occupancy. So the single family rental model is, I think, only going to grow in popularity, especially the build to rent model. I think is going to continue to gain prominence and attention and investment dollars as people build out these communities specifically to rent to people. There's a high demand for it. And I think this chart is really interesting, kind of highlights maybe at least one of the drivers behind that demand. So this is comparing, the blue is suburban multifamily rent per square foot, and the gray is single family rentals per square foot. And you can see generally, with a few exceptions, the multifamily rent is higher than the single family rent on a per square foot basis. So there's a value proposition to moving into a single family rental. Now, granted, the unit makeup is probably going to be a lot different. So you might be moving from an 800 square foot apartment into a 1,200 square foot home. So now maybe you're moving from a 2-bedroom to a 3-bedroom. And, a lot of couples, I think this applies to, where maybe the dollar for dollar rent is the same or even more, but you're getting more for your dollar. You're getting more space. Now you've got maybe a home office or a guest room and a nursery or whatever the case may be, maybe even some outdoor space and a garage or something. But this just highlights, excuse me, what that potential value proposition is from a renter's perspective. So it'll be interesting to see if single family home rents start to outpace multifamily, because it's arguably a more attractive, product. It's a more attractive product, depending on, what your values are. Obviously, it's tough to compare an urban core to a suburban rental, but this is specifically looking at suburban multifamily versus single family. So maybe it comes down to amenities for the multifamily to compete and provide pools and gyms and stuff. I don't know. All right, so that is the presentation. So thank you for attending. That takes care of the formal part. That's kind of what we discussed. We went back, we looked at 2020, where we started. We looked at the performance of the economy and real estate in 2021 and kind of where we expect to end up. So I think the bottom line is we're going to continue to see price growth, rent growth. Inflation is going to stick around for the foreseeable future, and we can expect some interest rates to start rising. And in fact, I think we're already seeing those interest rates rise. I think I got some email bulletins last week or two about rate locks. What you can get for a mortgage is starting to rise by whatever 50 basis points or something. So we'll see. All right, and that's it. If you haven't already, you can go to my website. So on the bottom left there, you got mach1equity.com/take action. You can fill out an investor questionnaire, provide me a little bit of info about yourself, what you're looking for, what you want to accomplish in real estate, what brought you here, and hopefully I can find a way to help you. If you have any specific questions for me or just want to reach out, you can find me at keegan@mach1equity.com. And I think that'll do it for now. Thank you, Ingrid. I appreciate it. Let's is it still going? Still going. Okay. Let's switch into question and answer. So why not, if you guys have any questions, I'll stick around for a few minutes and be happy to answer any of those. And hopefully there's not, hopefully I didn't confuse anybody, but if there's just something that you wanted to discuss, we could take a look at that. Favorite markets for 2022. I think for me, I'm starting to look at I'm trying to think. I think it was the Marcus and Millichap 2022 multifamily outlook, whatever they call it. So you can look for that online. I think they had a chart in there that showed the emerging tech hubs across the US. So they had kind of it broken down to gateway markets, established tech hubs, and emerging tech hubs. So I think some of those emerging tech hubs is where I'd maybe start to shift my focus to try to find value and yield. Because I think that a lot of stuff is just overpriced right now. Like I said, I'm not buying a 3 cap, generally speaking. And, I don't know, if you buy a 3 cap and there's a lot of value add, did you really buy a 3 cap? Like, there's a whole discussion that can be had on that. So it's a tough question to answer, but I think for me, I'm looking at some of those maybe more emerging markets. I'm trying to remember, like Tulsa, Albuquerque is one that I've been looking at for I feel like 3 years, and I've always been hesitant because they have high crime, and poor schools. And also their population growth is not there. It's basically like a flat line. So I think there's potential there because Albuquerque is always showing up in the rent growth charts. It's always like top 5, top 10. Sometimes it's like number 1. So I think there's potential in Albuquerque. There's just a couple issues I'd like to see turn around, namely the crime, the education, and the population. I don't know if there's much they can do about the population, but we'll see. How come the increasing interest rate not affecting the real estate market? How can we get the slides? What cap rate? Okay, so anonymous attendee asks why interest rates are not affecting the real estate market. So this is what I was talking about with there's an influx of capital chasing multifamily and real estate in general from the institutional markets, private equity, all this capital and foreign markets as well is coming into the US. They're trying to invest in property. So they see the long-term value in it. So they're creating such high demand that it's offsetting any interest rate increases that might affect cap rates. Because the reality is, even if they go up 75 basis points this year, we're still half of what we were 2 years ago. It's not a significant enough change to the lending markets to really drive it in light of that high demand. And they're basically willing to overpay now in order to have that property for the next 15 years. So that's why I say there might be a case for kind of a shifting mindset to adopt that more institutional mindset of, hey, you know what, the first few years of ownership, we're willing to accept, kind of reduced cash flows, overpaid a little bit, or, bought it at a low cap rate, and how you define overpaying. But buying a property that you say, okay, yeah, it's not, the cash on cash isn't there. The 5-year landscape isn't there maybe, but 15 years, are you buying it for 15 years from now? Maybe that's something that has to happen. Will I be looking at assisted living? That's a good question. I was reading something when I was looking at this about assisted living having, kind of increased demand in the next few years. I don't know. If you just look at the pandemic for an assisted living operator, that's very challenging. I think that operators of assisted living are going to face increased operating expenses over the next 2 years because wage growth, especially, there's a lot of skilled labor involved there. And I think, a lot of times, what is it, like CNAs that mostly work there? Like I've heard it on presentations about assisted living and opening a private. Oh yeah, you can hire them for $12-15 an hour. I find that hard to believe going forward. So I think there's going to be increased pressure on operating expenses for assisted living for the next few years. So I just don't know enough about it to underwrite a deal like that. I'm not saying I wouldn't do it. If something crosses my table, I can get spun up pretty fast on stuff. But for now, it's not something I'm specifically focused on. But, I think for me, if I'm going to get into something like that, it's because there's a partner available that knows how to operate it. To me, that's the difference, right? I'm not going to chase that for me to take down and operate. But if there's a JV or an opportunity to partner with someone that needs help raising capital, I could come in as a partner for them and raise for something like that potentially. But I'd have to really believe in that operator. Thanks, Todd. Other question, more states are either implementing or looking at rent control. What is my opinion about this? Excellent question, Ingrid. So I didn't talk about political risk, but that is something. So Yardi Matrix puts out a political risk. I'm not sure where they publish it. So you might have to do some digging, but the Yardi Matrix has a chart there where they rank cities by their political risk. Well, it's not just political risk, but it's political risk. There's like there's like a dozen different factors at play. There's, how are they set up to deal with a natural disaster? Are they exposed to a natural disaster or pretty insulated from a natural disaster? What's the political risk? What's the affordability? What's their mindset toward affordability? What is the urban policing policies and outcome? So they look at a lot of that stuff that is a little bit harder to track from multiple markets when you're trying to compare apples to oranges. So I'd encourage you to look for that. If you can't find it, shoot me an email and I'll find it and shoot it out to you if you need. The recording will be sent out in the next few days. So as long as you're signed up for this, which since you're here, you are, you'll get an email with the recording in, probably by Saturday or something. What cap rate will I buy for Dallas apartments? I don't know. I'm not really looking at Dallas. I think Dallas has been chewed over in the last 5 years. Dallas has been like the it market for 5-10 years. So what's left there? I think lowest cash on cash and any rate you would underwrite for Dallas apartments. To be honest, it's too specific for me to answer because I'm not underwriting properties from Dallas generally. So I just don't really know. I think, and that's a personal question too. Like, cash on cash. Our Houston apartment, the first year might be 1% cash on cash, but that's because we were taking over a highly distressed property. So it's like that stuff can shift. It can go from 1% to 10%, 12%. Me and Todd's mobile home park, same thing. It's a turnaround. So the cash flow right now is, it's like just over break even maybe, but as it turns around, that cash flow is going to increase significantly into the double digits. So yeah, good questions. All right. I think it looks like that's it on the Q&A side of things. Thanks everyone for coming. I really appreciate you joining me, taking time out of your busy week. Leo's crying for dinner now, so I gotta go take care of the boss. But thank you guys. Appreciate you guys attending, and hope to catch you at the next one. We'll be doing another one in about a month, which will be a mobile home park case study. So if that's something that interests you, just a different type of asset class that's multifamily aligned, then hope to see you there. You're welcome, Eliza. Cheers, guys.